In the first video of this series, we laid a foundation for the new trader, going over those beginner topics necessary to propel you forward in your trading journey. But in this video, we're going to build up that understanding brick by brick with some core concepts that will better help you understand the different types of setups. As always, down in the description below is a link to this slideshow so that you can better follow along and have something to go back and review at any time. No matter what trading strategy you follow or look to follow, market structure is always going to play a big role. And having objective rules to identify where that swing high is and where that swing low is extremely important, because everything in the middle of that is going to be considered consolidation, and that is where traders tend to get chopped up the most and take the most loss. So I've got a cherry-picked example up here of a nice clean trend on a 1-minute chart, making higher highs and higher lows. But regardless of time frame, these rules can be applied to any time frame, whether that be the 5-minute chart, the 15, the 1 hour, or even down to a 1-minute chart. The trend is your friend until the end is kind of one of those little funny sayings. And knowing where your highs and your lows are can give you an early warning sign of reversal. Of course, we can follow the trend and take trades based off of the trend itself. But understanding when that reversal may be coming soon is also extremely important to keep you from getting chopped up or taking trades into an extreme, expecting it to continue and maybe expand a range, only to find it start trapping people and going the other way. So what were our early warning signs? Number one, we've been making higher highs and higher lows, and then we get these little 3 peaks, as well as this lower low right here. So we got this lower low first, and then 3 attempts to go higher, which eventually fails and then resulted in a reversal. Let's go over those objective rules for finding your swing high and your swing low. And there's always going to be a starting point, and this starting point is going to be wherever the market reversed from. And we call these pivot points. So lower lows, lower highs, making a downtrend. And then that point at which we made this lower low, and then we've made a higher high. So this is going to be the place where they break structure to the upside. That first indication that the trend might be reversing is that first higher high that is made. So we're making lower lows and lower highs, and now we have a solid candle close. The body of this candle has closed above that previous swing high, signaling our break in structure, signaling that this trend to the downside may now be reversing. All right, now as this starts to pull back, this step is extremely important. So step one being this higher high being formed, that is our break in structure, signaling that the trend may be about to reverse. And now we have 1 bar back down, 2 bars back down. And I want you to take note of the fact that after we've made this higher high, these 2 down closed bars are significant. They're not contained within this one little bar here, pulling back, because a lot of times what will happen is it'll just continue to go higher. No, these 2 bars are significant because this bar closed lower than all of these bars, and then this down closed bar also closed lower than those bars, which is a significant down move, which may indicate that we can receive a new higher low being formed, or at least this is going to confirm a swing high. All right, so we broke the high, break in structure, step 1. We've made a higher high. Now we have a 2-bar pullback, which is now going to allow me to draw my swing high. All right, so break in structure to the upside, 2 bars of pullback that are significant. Once that happens, draw your new swing high. So from this, now we have a swing high and a swing low still in place. That is my high, that is my low. And until one of those levels is broken, those levels will remain in place. So everything in the middle of these 2 points is now consolidation. However, after we come off of this 2-bar pullback and we break back up to the upside with a solid candle close above that swing high, and usually I would prefer to see a larger bar closing above. However, the rules do still apply. This bar closed above that candle's high with the body, not just a wick. What I can do now is draw a little U from where that high was formed down to the lowest place that it pulled back to, back up to where that high was broken. And this will now allow me to draw my swing low. And once again, the process will repeat. Now this is my high. Now this is my low. And everything in the middle is consolidation. For a downtrend, this exact thing can be repeated, but in reverse, making lower lows and lower highs. They make a new low. I draw my high, they pull back in 2 bars, And when they break that low, I can now draw my new swing high and my new swing low. So in day trading strategies, there's going to be a lot of instances where you're able to go short in an uptrend, or you might be able to go long in a downtrend. But you have to understand, when is that actually required, or when is it, I won't even say necessary, but when does it actually make sense to do so? So looking at this picture, we were making lower lows and lower highs, and we actually made a higher high, but this was the first time that they made a higher high. Notice how we made this lower low, and then it actually blew off in a direction outside of this high. And with our understanding of structure, that after they make a new extreme, this is a new extreme. We were making lower lows and lower highs. They broke into the upside. That is a new extreme being formed. In most cases, or a lot of cases, there is going to be a pullback. There's going to be some kind of 3-push pullback, and we're going to talk a lot more about 3 pushes later in this series. So with that understanding, if we have blown off in a direction, for example, in this case, this is over 70 pips outside of that previous swing high. And then we get this little engulfment bar here, which this bar closed lower than that previous bar, giving us that engulfment. We got a lot of space to get from that point back down to that level. So if we were watching this and I was looking for a sell high opportunity on the day for whatever reason, it doesn't matter, and I see this and I say, okay, well, they just made a higher high, but I could still benefit from this because it is lots of distance to get from this high back down to this point here. I would still maybe be willing to take that trade, compared to if they just made a slightly higher high and then started to pull back. Now they've made a higher high and are pulling back. It's actually more intelligent to maybe look for a trend trade rather than this style of reversal or counter trend reversal. Trend is up, but has blown off in a direction. Should I take the short? I can, but I need to be aware that once the low is broke, there is likely to be a pullback. So it is smart to take profits off the table, saying that I should be willing to take profits very quickly in this example, compared to looking for a larger swing. I consider these counter trend moves as scalps, so I will risk less on the trade. The low needs to be far enough away for the trade to actually have enough reward for it to be worth entering into the market. That's what I was saying about the 70 pips of blow off. They've blown off more than 70 pips, giving me plenty of opportunity to get back down either to the breakout level or ultimately back down to some of these higher lows down here, which obviously you can see the market made it back down to. And continuing that discussion, here's another scenario. If the trend is up and has pulled back into the previous low, should I take the trade at the low? It's very high risk. You are entering into a trend at the worst possible place with the least amount of reward and the highest amount of risk. So in that other example that we just saw on the previous slide, notice how the market had blown off and was up 70 pips up here, but this has just broken the high. And instead of continuing to go higher and maybe close, all the way up here, we've essentially just broken out and then started immediately pulling back. So breakout, pullback into the previous swing high for the trend continuation to go higher. That would mean that I would have to enter on maybe one of these bars here, which is really not intelligent because this entry is on top of where my reward should be, or maybe back down to here, sure, but ideally, you're taking a trade from up here, and then your first take profit would be that swing high. So this gives me absolutely no reward and the highest risk possible. The chart has made a lower low and then a higher high. What should I be waiting for? That's a very common question. So we had a higher high made. We'll just use this, all right? Now, this could have been a break-in structure, break-of structure, but they've just made a higher high on a higher time frame. And now we start to get our pullback. This is that double top that I was just talking about, indicating that a pullback is coming. And from that pullback, we have the double top formed, burst 1 and burst 2, and then the third burst down into the low and a consolidation. And then, of course, the reversal or the trend move on a higher time frame, but a reversal on this lower time frame. But essentially what you're doing is now getting in line with what the larger time frame was doing. We had a break, a pullback, and then now looking for that continuation. And notice that underneath burst 2, coming into burst 3, these people down here are selling at the worst possible place in the chart. This one bar alone, if I sold any of these bars down here, would have caught these people down low, and then they are not letting them out. Just a small behavioral thing to notice as I'm going through these examples. But we're going to talk more about market traps later in the series, so if this is too much for you right now, don't feel like it's, overwhelming. So looking at this down move, though, 3 bursts into the low, getting in line with the actual trend, and then taking that trade in the direction of that trend. Now that you have an objective way of identifying your swing highs and swing lows, which, let's be honest, is half the battle, we're going to talk about some commonly used chart patterns. Now, I don't use every single one that's out there. I use mainly the double top, the double bottom, triple tops, triple bottoms, half Batmans, head and shoulders, inverse head and shoulders, and the ascending and descending triangle. And some books that you can reference are these up here. I've spelled this gentleman's name wrong, unfortunately. Peter Bradt, 2011. Yell at me in the comments if you'd like. Technical Analysis and Stock Market Profits, 1932. Technical Analysis of Stock Trends, written in 1948. And these will go over tons of patterns, maybe not necessarily that will make you better at trading, but just to help you better understand classical charting. You can also just Google any one of these patterns and you will find tons of references. Over here on the right, this is just a picture of a double top or an M. This is the first peak or the first leg of that M. And then the second leg of that M, driving traders into an extreme, forcing them to buy, thinking that it's going to go higher, and then reversing back down. And this is called the neckline of that M. Think about the M. It's just the middle peak right here where they came back down and created this kind of middle section of the M. That is what is referred to as the neckline. The 15-minute chart is making higher highs and higher lows. Let's refer back to those previous two slides and also remember from the first video where we talked about fractal markets. If the 15-minute chart is making higher highs and higher lows, lower time frames will give those short signals, but what those short signals are is just the indication of a pullback. So with this 15-minute chart making higher highs and higher lows, on a 5-minute chart, we may have got maybe like a double top over here or some kind of shorting signal. But again, is it really worth to take the trade, or should maybe I just wait for the pullback and for the continuation move so that way I can get in line with the trend? And that's really going to be determined by, like I said in these previous two slides over here, how much reward do I have relative to my risk? In an example like this, I would be willing. In an example like this, I would not be willing. Now, in my day-to-day trading, I mainly use those M's and those W's. Whenever I notice the head and shoulders and things like that, of course, I will react accordingly. But overall, these things are just peak formations. The ascending triangles and descending triangles are usually going to be continuation patterns. But these double tops and double bottoms are a reversal pattern. And they usually are going to signal the next leg of a move or a reversal altogether. So looking up here, we have that first peak. There's the middle point of the W and the neckline, and then the second peak or the second leg of that W for the reversal. Of course, over here, I've got a separate variation of this W. It's a pattern within a pattern. This W here, and when they come back down, there's going to be instances where you have a pattern within a pattern, but also these micro double tops and double bottoms. Whenever you could have this 4 or 5 bar pattern where you have a down bar, an up bar, a down bar, and then an up bar. So this creates sort of this little W appearance over here. And if you look at a line chart, you'll see it even better. And I have the different variations of these M's and W's listed down below. You have the shortened, the extended, the equal, and the micro. This one that I just described here would be considered the micro. And I've actually listed out or kind of drawn out the different variations of those double tops and double bottoms. Where you have your first peak lower than the second peak, this would be considered an extended. Where you have your second peak shorter than the first peak, this is going to be considered a shortened version. And of course, whenever the tops are equal, that would be considered a equal variation of a double top. So far, we've gone over how to identify your swing highs and swing lows, as well as some of the commonly used chart patterns. Those things are going to be extremely important later on in this series because those are like some of the main things that I use for entries and identifying setups. Now we're going to get into the 3 things that markets do. So if you don't understand those other concepts first, go back, rewind, watch those parts again, really truly understand the rules and the different types of patterns. Maybe go back and Google a few of those patterns so that you can memorize them, maybe print them off or whatever, before we get into these 3 things that markets do. So a commonly used phrase by Stacey Burke is the 3 things that markets do is breakout, pullback, and trend, breakout, reverse, or stay inside of a trading range. And what he's really doing here is describing the 3 types of market conditions. Lots of different authors have books and things out there, trading information about these 3 different types of market conditions. Notably, Al Brooks, he has 3 different books: Trading Price Action Trends, Trading Price Action Reversals, and Trading Price Action Trading Ranges. These 3 market conditions have different ways of trading them, and being able to adapt to them is extremely important. Understand the characteristics of each type of market condition and how to trade each or win or just stay out altogether. Most important to this style of trading, everything in between a high and a low is consolidation, which makes it easier to get chopped up trying to choose a direction, which is exactly what we want to avoid. Those are 50-50 or maybe even less kind of trades where you have very low probability of success. Previous day's high and low builds a consolidation. Man, this part that I'm about to say is extremely important, so maybe turn up your volume, or maybe I should speak a little bit slower. The previous day's high and low build a consolidation. The previous week's high and low build a consolidation. The high and low of the current week build a consolidation. The high and the low of the current day build a consolidation. Read these 5 points a few times. I promise you, they are going to be extremely important for your understanding. Look at this little image here of the NASDAQ on a 15-minute chart, and I've described the 3 market conditions within this one chart. All right, so we had a breakout. All right, the breakout failed up here. We broke back down to the downside and pulled back. So this breakout of a previous day's level, this failed breakout up high and a breakout to the downside. There's our high, there's our low. This is our consolidation in the middle. And then now we have a pullback to that breakout level. 3 peaks, 1, 2, and 3. And then now we're in a trend move. Breakout, pull back, trend the market. So now we have another breakout. We broke out of a previous day's low, and we also made a new swing low. So we're breaking out to the downside. Breakout, pull back, high of day, breakout, pull back, high of day, high of week. This little dotted line here is a new week starting. So we're breaking out to the downside, we're pulling back, and you can see at the extremes of the day and also the extremes of the week, that is where the trend moves continue. High of day, high of day, high of day, high of week, breakout, pull back, high of day, continuation. That is going to be extremely important for you to understand. You may have just heard me make reference to the high and the low of the day, also the high and the low of the week. Why are those levels important? Trading at the extremes of the day's range reduce your risk and allow for the greater profit potential. Think about it. We've pulled back. We're in a down move. We pulled back. We're at the high of the day looking for that sell high opportunity. Where is our reward? The low of the day, the low of the week. Where is our risk? We're getting in at the high of the day. Our risk is the high of the day. So we have a much larger reward potential than we do risk. High probability and reversal trades will come from these levels, as well as the high and the low of the week. So a little bit of a thought process exercise. The market is broke out of a previous week low last week and closed outside of the previous week's range to the downside. What is that? It's a breakout. Think about the 3 market conditions. Think about the 3 things that markets do. What kind of trade should I start looking for on that pair the following week? Sell high opportunities, high of day, high of week. Just like I said, breaking down, making lower lows and lower highs. So this previous week's low right here, remember that dotted line is our new week starting, new week starting, new week starting. So this is the previous week's low here. And this market has broke out to the downside and closed lower. That is a breakout to the downside. And in the process of doing so, they have pulled back and gone back into consolidation, making lower lows and lower highs. We have a high and a low in place and a consolidation. And if we were looking for this trend trade, lowest amount of risk possible. High of day, high of day, high of week, high of day, high of week, looking for the trend continuation. Now, I'm going to show you later on in this series setups that will help you find those larger moves over the course of 3 days that will be widely beneficial to you. But for now, just understand that the high of the day and the low of the day is extremely important for taking high probability, good trades. With most of those examples that I just showed you, those were breaking out and trending. But there was also some failed breakouts in there and ultimately trading ranges as well, where the breakout and then you have a high and a low and a consolidation in the middle, consolidation, trading range, we're in between a high and a low. But what happens when you get those failed breakouts? What can you actually expect? So I've labeled it off in 3 different scenarios. Number 1, a breakout fails and reverses back to the other side of the consolidation. So if you had a day's range, high and a low, the next day breaks out, it fails, you can expect it to go back to the other side of the day's range where that breakout has failed. A breakout fails and then breaks out to the other side. and maybe we're going to start a new trend. A breakout, it fails and returns to 50% of that range, goes into consolidation, puts in a base, and then breaks out and continues to go in the original direction of that breakout. So the breakout that failed pulls back, goes into consolidation, and then continues to trend in the direction of the original failed breakout. So example 1, breakout fails. So we had a previous day's range over here. This was the day's range. This high right here and this low down here. The new day starts dictated by this dotted line. They attempted to go higher, but it failed and it closed down here. And on the following day, we've returned back to the other side of that day's range. Next example, we have a breakout that attempted to go lower the following day and then failed and actually broke back up to the upside. This is usually going to be a strong opportunity for me to look for a buying opportunity the following day, but we'll get into that a bit later in the series. Just for now, understand that these failed breakouts have a lot of meaning. And then also the failed breakout. So this market had a large up push. We had a breakout day here and a failed breakout day here, and then it pulls back and goes back into consolidation for multiple days. 1 day of consolidation, 2 days of consolidation, 3 days of consolidation, and then eventually we get this trend move on the 3rd day to continue in the direction of that failed breakout. And you'll note this high and this low down here, we came back to the 50% of that range, put in a base over the course of 3 days, and then continued to the upside. Very common pattern. All 3 of these, very common, very important. Some important things to understand about the previous day's high and previous day's low, which also translate to things like the previous week and previous month's high and low, just to kind of gather some information about what those levels actually mean, aside from the failed breakout and breakout trend aspect of them. When one side of the previous day's high or low is hit, this triggers breakout traders into the market. Important for determining what kind of weekly template to look for. The understanding of these levels in combination with truly understanding the 3 things that markets do will significantly help you to find the best 3-day templates, again discussed later in the series. The previous day's high and low, the previous week's high and low are the cornerstone, the foundation, the brick by brick, the walls are built. The previous day's high and low, the previous week's levels are the building blocks of this entire trading system. So truly understanding what those levels mean is really important. So whenever one side of the market gets hit, that's automatically putting money at the other side of that range. For example, notice over here, this is a trading range. Peak formation high, peak formation low, double top. It's more of a V bottom, but on a lower time frame, there's probably a double top there. Regardless, there's a high, there's a low, there's a consolidation, and now we're breaking out to the upside. So breakout traders are being triggered into the market as we continue to go higher and higher. And now we've had a breakout that has failed at the high of the day and also the high of the week and is in now kind of a seeking mode. They're going back for the money. And where's that money going to be? Well, if I traded the breakout of this day, I may have put my stops at the low of the day over here, or maybe back down over here. These people are now triggered in and the market is going back to grab the money. Now we're broken out to the downside and we're pulling back, maybe stopping out traders that are at break even, pulling back to these breakout levels because again at break even, maybe getting people to go long, things like that, before reversing and once again going back for the money. If I started going long in this up move, thinking that this is going to reverse or maybe continue this trend that was over here, I'm now caught and I put my stops down here. They're going to come back for that money. Now we have another example. Again, we've got 3 days of breakouts down. They have to go back for the money. They can't just continue to go in one direction forever. That's not how the market works. So we get down here and we may be, I don't know, a little overextended or something like that. We've broken out to the downside. We got to go back for the money. Break-even traders, people who have put their stops at the high of the day or the high of the previous day, and go back for that money. And once again, the process will repeat. Peak formation high, peak formation low, consolidation in the middle, and it starts all over again. We're going to do a quick introduction to closing price. I want you to think back to the first video of this series when we talked about the open, high, low close of candles. And some of the things that I talked about in those slides were traders buying and selling the close of those bars. Closing price. There are traders that will buy and sell at the end of strong and up close and down close bars, regardless of time frame, whether it's the 1, 5, 15, daily chart. It doesn't matter. The human brain is going to work the same. So if I'm trading on a 1-minute chart, the up close bars on a 1-minute chart are going to force me to want to buy or sell, depending on, of course, the direction. People's behavior does not change. we see a strong push, our instant reaction is to believe that will continue. So we as humans will take action either buying or selling in those areas of the chart, which if you understand that, you can understand where people are getting caught. And once we go into the 3 pushes class and the market traps class, you're going to understand that hopefully even better. This is where people are getting trapped at the close of these candles, attempting to buy and sell. If you're able to observe this behavior, significantly will help you, or will help me in my thesis the night before, the day of, and the session I am trading, or right before I am about to enter. This is going to help me put my stop loss. It'll help me to look for targets and things like that. When we get to the market traps, 3-day cycle, and other topics later in the series, your understanding of this slide is going to be extremely important. So again, highlighting that this is a more important slide. Really, all of these slides are important, but make sure you review this one a couple times and truly understand what I'm saying. Maybe even go back to your charts. Go back to your charts, look for those really strong up close, down close candles, and when they reverse, are they letting those people out? If they're going down, really strong pushes into the low, which bar reverses and doesn't let those people out of their positions anymore? If I'm shorting down into a low and then one big bar comes back up, if I shorted any of the bars on the left side of the V or the left side of the W that may be about to form, you know, what bar completed the pattern and no longer allowed those traders back out of those positions? That is a very important thing for you to understand. If you've made it this far in the video, congratulations. This is a lot of information coming at you at once. I really understand. Go back, review this video a couple more times. Go back to the first video in the series and review that one as well, because in the next video, we're going to start getting into some more advanced, but not too advanced topics, but it's going to really piggyback off of these previous 2 videos. And your understanding of information in these first 2 videos is going to significantly help you going forward. Additionally, if you've made it this far in the video and you feel like, I don't understand how this is going to help me, I just don't get it, I don't understand why this information is important yet, you're going to have a lot of aha moments in the next 3 videos where the information from these past 2 videos is going to spike back into your brain and you're going to go, oh, that's why that was important. Good stuff. Ladies and gentlemen, I hope this video has been useful to you. If it has, please do me a favor, leave a comment down below letting me know what you thought of this video. Your feedback is greatly appreciated. I hope you all have a great day and a great rest of your weekend, and I will see you in the rest of this series.